Prospector News is media for educational purposes only and should not be construed as advice. We are not a certified financial analyst, licensed broker, or fund dealer, exempt market dealer, or hold a license to provide financial advice. We provide no legal opinion regarding accounting, tax, or law issues. Nothing in this podcast should be construed as investment advice or the solicitation to buy or sell stocks or commodities. All opinions expressed are those of the participants and should not be relied upon when making investment decisions. Those decisions should be made with the advice of a personal financial advisor. If you have enjoyed our podcast, please hit the like and share buttons and be sure to hit subscribe. I'm Michael Fox, and this is the Prospector News Podcast. And joining me today is the national investor, publisher, Chris Temple, longtime contributor, close friend, and just nicely back from vacation in time for the Fed interest rates.
Well, I guess you can say vacation. I try and keep up with things as best as I can while I'm away, but I have to say I listened to the news yesterday, Mike, on Wednesday, and Powell's press conference on the fly somewheres along Interstate 24.
Well, at least you had nice scenery to look at while you were listening to it.
I did. Yeah, we sure did. I'll tell you, one of the prettiest drives you can make is coming across central Tennessee on Interstate 24. You go up and down Mount Eagle Mountain, pretty day.
Sounds like heaven. So go from heaven straight into hell. The Fed.
Yep, that's true. Well, look, most people had expected the Fed to continue to talk tough. Whether it acts that way to the extent that they told us this week still remains to be seen. Of course, it's been fairly widely reported that so far, despite the interest rate hikes, the Fed has done almost none of the balance sheet roll-off that they said they were going to do. Powell reiterated that they're going to get more serious about that, including even selling mortgage-backed securities, despite mortgages today hitting their highest yet again in a long time, 6 2/3% or thereabouts for a conventional 30-year mortgage. I was even a little surprised, I got to say, with the level of the hawkishness, because, and you know me, I've been saying all year long, when a lot of people were regularly saying the Fed was going to blink, I said, no, they're serious about this. They're going to continue to raise interest rates. That's their political imperative. They're going to continue to sell the idea that getting rid of inflation now and enduring that pain is less bad than what's going to happen to all of us if they don't do it. And of course, this is a problem chiefly of their own making. We know that. But I have to say that a couple of things that Powell commented surprised me even a little bit. The biggest one, as I said in an email I sent out this morning, before we made the last leg of our trip and got home this afternoon, was his insistence that it's very important that the Fed get back to positive interest rates across the yield curve. And I don't think that part of things really has sunk in yet. Everybody's micromanaging the dot plot and, taking seriously all of it when some of the numbers are just absurd. I mean, for example, when Powell used every term but recession, and in the way he did it in answer to one question was really humorous, I thought. 0.2% growth and then 1.2% growth, no negative, prognostications, which is lunacy for what they're going to be doing to monetary policy. But when he talked about going to positive real interest rates again, what if inflation only comes down to 5 or 6%? And levels off there? Does that mean that he's not going to stop raising rates until the federal funds rate is 6.5 and long-term rates are 7?
That's going to do a lot of damage if they get the rates up that high.
of everything he said, that's the one that I walked away with, is because I've said for a while, and I could be proven wrong, of course, by events, wouldn't be the first time, that I may not live to see positive real interest rates again, because I don't think inflation is going to come down a great deal, barring a major depression globally. And then that would only be temporary. But aside from that, there are many, many reasons that you and I have talked about before here and elsewhere why, under normal circumstances, we aren't going back to 2%. There's a lot of structural things now baked into the cake that are going to keep inflation quite elevated. So I want to see him pull this one off. That again, to me, is the most interesting thing. But bottom line is, until they break something, the Fed is going to stay more serious.
Yeah, I think those remarks caught the market by surprise as well. Like, I was watching the Dow yesterday, and it kind of reacted the way that I thought it would. The initial downturn off the announcement, because, you know, 3/4 of a point interest hike was substantial. Then I expected it to kind of bounce and accelerate on an upward trend, because, sigh of relief, it wasn't a full point like some people were projecting. Then I was really shocked when the market took that downturn towards the end of the day like it did, and I was trying to figure out why, and it was the dot plot and these comments, I think.
Well, it was, and there was one time during Powell's press conference where he commented basically that the Fed is going to remain flexible. They're still going to be data dependent and all that. And so theoretically, if we get a couple or three successive inflation numbers that do show a bit more softening, unlike the last one that gave the market fits, of course, there recently, that maybe they will relent a little bit. You know, he gave himself on the surface a 1/4 point wiggle room for the balance of the year. So if you take things at face value, we're going to get yet another 75 basis point hike in November. Nobody was betting on that before this week's meeting. And then 50, they'll go down to 50 in December and play Santa Claus more than Scrooge, I guess. And then maybe another 1/4 point at the next meeting. And that, by the present trajectory, seems to be how they want to get to a point where they at least pause for the moment. Not, you know, but who knows? You know, the 1/4 point wiggle room he gave us, maybe if we only get a 50 basis point hike next time, because things have softened a bit more, maybe the markets will react positively to that. The other thing I think that hurt everybody's psyche just as much as all of that was to finally, under present circumstances, and again, this is subject to change if the Fed breaks something, but under present circumstances, they show no chance of any reversal in interest rates until well into 2024 or something like that. Certainly not next year. And people were thinking, you know, that still is a possibility.
Well, I'm reluctant to think that they can even pause at the end of the year if they're hell bent to try and track inflation down, because, as you know as well as I do, as we get into the cold of the winter, those energy prices are going to start to spike up again, and energy goes through every bit of our economy, and that's likely to cause the inflation rate to start to spike yet again. What does the Fed do then?
Well, that is one of the reasons, Mike, why I think that inflation is going to stay elevated. You know, if we're lucky, we'll come down to 5 or 6% by you know, sometime next year. Who knows? But for sure, this proxy war that the Biden administration and NATO has got us in with Russia, and what that has done to natural gas prices, and in turn, the criminal. I mean, that's one criminal act, in my opinion. Some people will disagree. The other criminal act on the part of our own government, having got us into this mess, is to basically screw the American people in the name of their war aims. The American people had all kinds of natural gas going forward as far as the eye can see at $2 or $3 per MCF. Now we're between 7 and 10. And a lot of people are seeing doubling and tripling of their home heating costs and cooling costs already this summer. It's going to get worse most likely this winter. So you're right. There's not going to be a lot of relief on inflation. Real estate and housing costs are not going to come down immediately. There's still a lot of liquidity in the real estate market. Certainly down here in the US, there's been a meaningful dent put in the real estate prices where they got the most extreme. The area that I live in here in Florida, I follow the regular Zillow listings for my area as well as areas inland that are more rural. And for every one listing I saw at the beginning of the summer, I see 3 right now. And everybody is kind of coming to the realization all at once that, this was just another 2007 and it went by us. We may have missed a peak, and who knows when we're going to have a bottoming of however this downturn plays out and get a chance for rebound. So a lot of people are listing their houses. So, that's going to impact one element of the real estate market. But the other issue, and this is one of the ways in which the CPI, as much as everybody has wrung their hands over it, does still understate the real facts of life out there, is that, the rental market, what it costs the average person that can't afford a house for rent, it's crazy in the majority of the country. And those costs have gone up far more than what the numbers reflect. And that's not going to come down right away. It inevitably will, especially if, as I expect, we don't have so much a dramatic crash of the markets and economy and then a frantic, massive reinflation. But maybe for several years, we get a slow, dull ache of stagflation as this all plays out. It's going to take a while under that scenario for housing costs for the average person to come down meaningfully, let alone, first they got to stop rising, and they haven't done that yet.
No, and I agree. Like, it is a complex ecosystem.
Yeah.
If they keep raising the rents, the mortgage rates go up, and the ability of a buyer to afford a home starts to diminish. And if that's the case, they stop being a homeowner and they become a renter. And if there's not enough rental stock, like there currently is in a lot of cities in North America, those rental rates are going to continue to rise, putting more inflationary, pressure. So it's almost like the cure for the disease is going to kill you.
Well, that's very true. People should look up an outfit here in the US called the Coalition for National Infrastructure Bank. I think that there are a lot of people making noises. And in fact, let me give you the website. It's NIB, which stands for National Infrastructure Bank Coalition.com. And they're pushing back on this whole notion, Mike, of we only have 2 choices. Either inflation stays hot, the Fed doesn't respond to the mess that they created by printing too damn much money the last couple of years. That's choice number 1. Choice number 2, which Powell is giving us now, is the 3 H's, as a couple of people have called it, and I quoted that this morning also. The 3 H's are: number 1, rates are going to go higher than what we were told originally. Number 2, they're going to hold at those higher levels for some time to come until the Fed thinks its job is done, such as it is. And the third H is hurt. They're using these terms like hurt and pain. Pretty much they're going to start sounding like one of those 70s era slasher movies for what they're going to do to the economy to help us, as they try and bring costs down. But it doesn't have to be just those 2 choices. If we do an end run around the Fed and realize that there are ways in which a nationalized type of credit, so to speak, even a private sector credit or augmented credit, can be used in massive ways to make sure that we have good jobs for people, build and rebuild infrastructure, affect the energy transition, and all of these things, and do something like that, but do it in a way that it doesn't always have to revolve around the Fed, because it's because of the system that we have this binary choice, neither one of which is a good choice. when it comes to people and the economy. So I'm not holding my breath that anybody is going to willingly do this anytime soon, but I'm glad that the conversation has started.
Well, yeah, it's really, in both our countries, there's been an infrastructure deficit for the last, oh, God knows how many decades.
Yeah,
And, at some point, that's also going to come home to roost.
right.
And possibly that may keep the recession from becoming a depression, and then that we can put people to work to rebuild some of that infrastructure.
Well, we'll see. Again, I'm not holding my breath that it gets done anytime soon. Certainly not going to be done, I'm sorry to say, voluntarily or during good times. We're going to have to face a much deeper crisis, and maybe that's where the Fed is going to be taking us in the end.
Yeah, if things get bad enough, sometimes it'll make for strange bedfellows as far as
Yep,
politics go, and you get stuff done.
true.
So the Fed, in my mind, has limited resources to fight inflation. Let's talk about our governments. Do they have a role to help knock down energy costs to help curb inflation? I got to tell you, when I see Biden going over to Saudi Arabia begging for oil when, we're a friendly neighbor and can provide it, except for the pipeline that he canceled, it kind of makes me kind of pull my hair out.
Well, I'll tell you, Mike, the whole situation with inflation has definitely been exacerbated by the decisions that policymakers have made. There's the war. By following, unfortunately for them, though there is a considerable amount of pushback in Europe that doesn't get reported that much because the press won't let you know that Europe has had enough of being put in the middle by the US and its war intrigues and pining for years, as a lot of the war party in this country has done. They've been pining for years for a war with Russia. Now they got it. China's next. But if we had people in positions of power that were more concerned about butter than guns and infrastructure rather than war spending, look at the amount of money that has been spent on global intrigues and war. This last year has seen for the first time ever $2 trillion globally in spending on military and armaments and so forth, because there's a lot of money in it and power for people who want that money and power. It doesn't do the average yokel a bit of good. Joe Sixpack and Sally Soccer Mom didn't get up one morning and say, gee, I want to pay 3 times more for the heat to heat my home this winter so that we can show that bad man, Vladimir Putin, who's boss. I mean, what kind of idiocy is that? But that's where we are. So, and aside even from the war, as we've talked about, policymakers in this country, Canada to some extent similarly, they've actually hindered the transition toward a green economy in a number of different ways, making the permitting process that's needed for development ready projects for battery metals and things like that. They've made it that much more prohibitive. I don't remember if you and I talked about this, if I've been on since then, but the end of last month, I was up in Ely, Minnesota. There was an event that Twin Metals Minnesota put on, trying to, beat the drums for what their project means for that region and for our country, and for our ability to be able to fend for ourselves on a number of strategic metal fronts and that type of thing. The Biden administration, Joe Biden, when he campaigned for president, went to Minnesota and lionized that project and others in the area as being necessary for our green transition. He's all for it, rah, rah, made in America. Then he gets elected and his administration kills it. And that's not the only place this has happened. So, you've got two kinds of people driving this bus alternately, Mike. You've got people who are starry-eyed idealists that think electric vehicles come out of a magic extrusion machine, and you charge them with fairy dust and unicorn piss. You don't need to make anything. You don't need to mine anything. You don't need to fabricate anything. You don't need to refine anything. None of that is necessary. And these people are just nitwits. They should have no ability to affect public policy because they're incompetent. They have utterly no idea of the things that they've been put in charge of. And you've got the other ilk, which consciously knows the damage that they're doing, and are doing it willingly because they want to bring this country and Canada and Europe to their knees for their own private profit, in order to put a more draconian limitations on our lives afterward, energy and otherwise. And that's the lot, unfortunately, that we find ourselves in, as people, one of these two types that are running the show.
Yeah, well, I've keep saying over and over and over, we got to stop electing idiots to government,
Yeah.
but we keep
You know,
getting more and more idiots. It's like the same people don't want to even run anymore.
no, and they make inflation worse. And let me point out something. I was talking to a colleague earlier today about this type of a thing. We all can see on the surface, or should see, and you try and get people to understand this. I try and get people to understand this. The terrible damage that the Fed has done in the way it has run our fractional reserve system. We've gone from one extreme, and what Powell is doing now, after making the first mistake of printing too much money for too long, keeping interest rates low for too long. Now it's the equivalent of going 80 miles an hour down the interstate without even slowing down much first, all of a sudden doing a 180, and you throw the gear shift into reverse. And again, granted, they've not done as much as what they've talked yet, but you don't have to do a whole lot with as leveraged as things are to do some serious damage to the economy, let alone to markets. But look, I think that beyond all of that, if you have a development ready lithium project, or let's just pick an easy copper. Everybody knows that lithium prices are all over the map. Copper, more people follow. You've got a development stage copper project. We all know that copper is needed for infrastructure growth and a green energy transition, blah, blah, blah. Most decent sized projects go to a major investment bank or consortium of lenders for project financing, or some type of debt financing of one kind or another, provided, of course, the numbers work. They've done all of the PFS, the PEA, the definitive feasibility study at the end, and X price for copper, everything works. Here's your IRR, here's your net present value, here's all these other things. Who the hell wants to lend money when you've got a nitwit that veers from one side of the road and then to the other, running the Federal Reserve, and you don't know if 3 months from now, depending on how the markets react, copper is going to be $5 a pound or $2 a pound. So
yeah, and then they don't even know if their feasibility study is going to hold water with the rate of inflation.
yeah, and
There's been a
everybody's
few
costs going up.
projects that have been shelved lately because the cost to get them into production has grown so exponentially that they're no longer feasible.
Right. So this adds to the policy blunders or deliberate acts, whichever you want to pick, on the part of Biden and people like the EPA and the Interior Department, et cetera, who have hamstrung all this development to where we've already got chronic and worsening shortages of all these things that we're going to need to meet the promises of this green transition. And now it's been compounded by Powell, who, especially if he does succeed in bringing about a greater debacle in the markets, and you do have a copper price for a spell that is considerably less, what does it do for the financing odds of these things? And how much more does that exacerbate the lack of supply? And then in the end, make prices even worse and higher for all of these things they are already. So it's a terrible mess because of just a badly broken system, which frankly, in the case of the Fed, is flawed from the get-go, is a matter of simple mathematics. And I would like to think that there are thinking people who you could get around a table that are leaders of government and industry to get them to understand this, and that we've got to kick the Fed out of the room, or better yet, nationalize it. Don't let it be a private bank anymore that gives us this boom bust economy that Paul Volcker first gave us 40 years ago in his unappreciated second act as Fed chairman. But we'll see. I mean, so we're going to have the worst of both worlds. We're going to have a nasty stagflation where the economy is going to grind to a halt, maybe go at least in a technical recession. But beyond that, for the average person, the average household, you're going to pay inflating costs for the staples that you need in life. Yet your ability to pay for those things is going to deflate, mostly through asset price deflation, because you've seen the peak for real estate this cycle. You've seen the peak for the stock market this cycle. Even if they don't crash and just meander downward and erode a little bit, your ability to get a little extra juice from the wealth effect of your assets is now gone. So that's the world that Jerome Powell and his crew have given us.
Well, given that we're already in a technical recession, are we already not experiencing, well, I guess we're not experiencing stagflation because unemployment still remains low.
Well, yes and no. People play with these numbers all the time, and depending on what your bent might be, ideologically, you're going to go whichever direction is going to give you the results that you want. But look, the GDP numbers as they are, and even though we had the first 2 quarters of this year is negative, the third quarter is going to surprise people a little bit, probably still be nominally positive. But keep in mind, with all of these numbers, that when a government reports these things, they are using a very understated deflator, if you will, so that when they report GDP growth, it's actually better than what the true inflation adjusted number would be. So I would argue that we're already in somewhat of a recession. It's odd. It's not the textbook recession that we had in the past, before the Fed gave us this asset inflation driven boom and bust cycle that we've been in increasingly for the last 40 years. You've got a lot of households that, and I've said this before, you've heard me say this before, that the average American going into this summer, and I can tell you this with most of my travels, things were busy, saw lots of people out and about and so forth. For being cooped up for the last 2 summers, the average person didn't care if gas was $105 a gallon. They were taking that delayed vacation, but they're going to postpone replacing a refrigerator. If you got to put the dryer on for an extra 15 minutes because it's on its last legs, fine, you'll do that. You won't buy a new dryer yet. It's been very well reported that a lot of the major retailers are choking on excess inventories of clothing and a lot of consumer non-durable items besides the washers and dryers and things like that. So you've already got, where the retail economy is concerned, a very serious recession if you measure it by how much less people have spent on non-essentials, but they've still been traveling. We'll see what happens. I mean, here's an interesting little tidbit, Mike, that I can tell you that, and I actually kept track on the street that I live on from Highway 1 down here in Florida to where I live. It's maybe 3/4 of a mile or thereabouts, between 3/4 of a mile and a mile. And before I left, or when I left, I did not see a single for sale sign on a single piece of property here. I saw 7 today. So people are going to start bringing in their horns even more. They're going to start raising money where they can, which is going to hurt the real estate market, et cetera. And, people are going to tighten their belts. We'll get by. If I can leave you and our listeners with one thought on what dangers to look for, you can't look at the economy per se. The Fed can raise rates more. They can keep them up higher. It's going to squeeze households. It's going to cause more of a recession, and we already have, officially or unofficially, et cetera. But before we get to the place where the political cost to them and whoever is in charge, in this case the Democrat Party, is so high that becomes uncomfortable, they're going to break something in the markets first. And that has been very underappreciated. China has been an accident waiting to happen for a while all these central banks are tightening policy. China has been aggressively easing policy so that its increasingly unmanageable skyscraper of cards doesn't come tumbling down and take all the rest of the world with it, because of how much everybody is invested in China. Europe is a basket case. You've got energy companies. Germany just had to bail out the second largest utility in the country because they were insolvent. They were offside with a lot of their energy contracts and hedges, et cetera. It's a disaster. So the Fed is exacerbating all of this by being more hawkish than everybody else is. And it's odd to me, although in a sense, maybe not, maybe this is all by design. Maybe the conspiracy theorists are right that the Fed is going to deliberately bring about a depression so that they can bring us to new currency and all the rest of this stuff. Who knows? But for Powell to say the other day that, and I forget which meeting he referred to, that he and some of his Fed colleagues were just, it might have been a BIS meeting in Switzerland, but whatever international group he was with, he did comment that the discussion came up about the harm that the higher value of the US dollar due to his hawkishness was doing to emerging markets and the people in other countries. And what he basically said at the conclusion of that particular comment, his press conference, was, I don't care. So, they're on, you can take this in such a way that they're on almost a suicide mission, and they really don't care how bad the recession or market fallout is if they can push just as far as they go until maybe they think the first thing that breaks, inflation will have been brought down enough to where they can pivot then. We'll see. But again, when you're looking for what damage the Fed is going to do, don't look to the economy, because the economy can tolerate a fair bit. It just means everybody spends a little bit less. But look at who that hurts in the marketplace, who's offside the next time we get another spike in energy or something else, and what emerging market might be. We had the Asian crisis, if you remember, in the late 90s. We had the emerging markets of Latin America in the early 80s. We're on the edge of that same type of thing again.
So you think the danger is going to come from abroad rather than from within?
I'll almost guarantee, I can't guarantee anything, but if I could, I'd say yes. Long before something breaks of that seriousness in this country to cause the Fed to change, it's going to happen elsewhere.
Okay. See, I'm of the opinion that the Fed isn't going to pivot until unemployment levels start to rise dramatically. Out of work Americans will start to put pressure on the politicians, which would in turn put pressure on the Fed to pivot. That's always been kind of my end game on this, but I'm listening to you and I'm going, well, yeah, it might break overseas before it breaks here.
I think before we get to that point that you're talking about, which is kind of the mirror image of what got us into this place. I mean, the Fed, I think correctly so, has looked at the high inflation that they were the primary cause of as being the bigger political thing around everybody's neck. And they're right. And you're probably right in that the Fed wants to keep going, and they as much said this until unemployment does go up appreciably and it brings wage pressures down and stuff. It's odd, and this is maybe a subject for another day, but those of you out there in podcast land who have studied economics or followed these things for years, remember that for 40 years, a lot of academics try to get the Fed to abandon the Phillips curve, which again is one of these false choice binary things. If employment is doing too well, that's a bad thing, and the Fed's got to raise unemployment so that the employment growth and people making too much money, of course not Wall Street, but the Joe Sixpack making too much money is what they mean. They don't want to have that. And finally, it was only a couple of years or so ago that the Fed threw away the Phillips curve and said, especially now with the pandemic and so forth, we got to make sure everybody's working, everybody's got a good wage. And they have re-embraced that old Phillips curve with astonishing speed in the recent past. It's a bad thing.
Yeah, it is. It's, it's an assumption that correlation is causation, and it isn't necessarily the case. So
no,
if people want to hear more of your insights as the world turns, how do they reach you?
Go to nationalinvestor.com. If you're not already on my email list, sign up for my email list there. It's free. And better yet, if you want all my recommendations, we've had a great year this year, notwithstanding the overall market, because of some wise moves into things like natural gas and uranium, and several directional trades when the market has been volatile. If you want to sign up as a member, there's information there how to do that and get all of my recommendations.
Perfect. Well, until the next time, and we always have things to talk about. So we'll sign off for now.
All right, Mike, take care.
Thank you, Chris.